Hey everyone, George here. So if you're a contractor, builder, or real estate investor in construction, there's a good chance you're leaving tens if not hundreds of thousands of dollars on the table every time you sell a property. Today I want to walk you through 1031 exchanges. We're going to talk about what they are, how they work, and how contractors are positioned uniquely to use them better than pretty much anybody else. This is not theory, this is something real estate investors use every day to scale their real estate portfolio without getting crushed by taxes. So without further ado, let's get started. So what is a 1031 exchange? So a 1031 exchange comes from section 1031 of the Internal Revenue Code. And simply put, it lets you sell investment or business property and lets you defer paying capital gains tax, as long as you reinvest the proceeds in another qualifying property. So the key word there is defer, not eliminate. You're basically telling the IRS that I'm cashing out today, however, I'm reinvesting this in another property, so I'm not going to pay my tax right now. And the IRS says, okay, that's fine, we'll wait. That means no federal capital gains tax, no depreciation recapture, and usually no state capital gains tax either. For contractors who flip, build, and hold income producing property, this can be pretty big. So what qualifies for a 1031 exchange? This is where a lot of people get tripped up. So a 1031 exchange really only applies to either business use or investment property. So examples of what qualify, and I'm gonna put that down here so we can read pretty much a general list. So usually rental properties, commercial buildings, raw land held for investment, multifamily, warehouses, mixed-use properties, and properties owned by your business. These all would potentially qualify for a 1031 exchange. What do not qualify are your personal residence, second homes with few exceptions, and property you intend to immediately live in. But here's where it could get interesting for contractors. If you build or rehab, remodel a property and rent it out immediately, that could absolutely qualify for a 1031. So step by step, how exactly does the 1031 exchange process work? So here's the basic flow of this. Number one, you sell the property. Let's say you sell a small apartment building or commercial property. If you take possession of the cash even for one day, the entire thing is dead. That's where we go to step two. Upon sale, the money needs to go directly to a qualified intermediary. So this is a neutral third party that holds the money so the IRS doesn't treat it as a sale. Step three, you have a 45-day identification period. And in this period, you basically have to, in writing, identify a property that you intend on repurchasing. So this is where contractors have an edge because you can actually spot value add properties and get a lot of the work done yourself for a lot lower cost. Now step four is a 180-day purchase window. You then have 180 days total from the sale date to close on the replacement property. Unfortunately, if you miss the deadline, that's it. The exchange fails. There's no extensions or anything. Next, I want to talk about the like-kind rule. What exactly is it? So most people overthink the like-kind rule. Like-kind does not necessarily mean same exact property type. You can exchange, for example, an apartment building for raw land for a commercial warehouse, a single family rental for multifamily, or an office for mixed use. As long as it's real property held for investment or business, it usually qualifies. So for a contractor, that obviously opens the door for a strategic upgrade. And how so? So you can go from a smaller property to a bigger project, a low cash flow property to a higher cash flowing one, and a passive rental to a development opportunity. So how exactly do contractors have more advantages with 1031s? Contractors have three main advantages over the general public. You can add value cheaper than anyone else. Most investors buy turnkey properties, but as a contractor, you can buy ugly, dilapidated, outdated, structurally sound, but poorly kept, and force appreciation through construction. That means bigger equity jumps, bigger depreciation, and stronger long-term cash flow. Number two advantage contractors have are built-to-suit improvement exchanges. So what does that mean? That means you buy land or fixer, use exchange funds from a sale to basically improve that land, make it an entirely different property, say a new development, and the improvements count towards the replacement value. This can get complicated, but it's extremely powerful. The whole equity, the whole new additional capital gain gets deferred. And number three, you can scale without resetting taxes. Most contractors hit a wall because taxes eat away at their profit. But a 1031 lets you basically reinvest the profits, keep leverage working, and grow asset size without shrinking cash. This is how contractors go from one rental to 10 or one warehouse to portfolio. So what are some common mistakes or pitfalls that contractors make with 1031s? So definitely mistake number one is selling first, then trying to figure it out later. You must set up the 1031 before closing. Once the close happens, it's basically over. Mistake number 2 is mixing personal use. If you plan to live in the property immediately, that's kind of a problem. There are some strategies out there that I don't want to get into here, but ultimately intent matters. Mistake number 3 is underestimating timeline. So obviously 45 days can go by pretty fast, and 180 days can go by pretty fast too, especially when permits are involved. So really planning is everything. And mistake number 4 is using the wrong professionals. But this isn't exactly DIY territory. You need a CPA who understands these types of transactions in real estate, a qualified intermediary, and highly recommended an attorney if construction is involved. So what happens if you never sell? So this is the secret to it all. This is the real long game. You can keep exchanging properties through your life and basically never cash out. And when you die, your heirs basically receive the property at a stepped up basis. That can mean all deferred capital gains disappear. This is how real estate wealth is passed down tax efficiently. So if you're a contractor in the real estate game, not using 1031 exchanges, you're definitely playing the game on hard mode. Your construction skills give you more control, more upside, and more flexibility than traditional investors. So if any of this applies to you, our email and calendar link are down in the show notes. I hope you found this helpful, and see you in the next one.